Most of you already invest in the new 3-fund portfolio, or you're invested in a solid position in like the S&P 500 or the total stock market index. And the idea here is that you're probably wondering, how can I add something more to this portfolio to either spice it up or to make it more safe? And that's what this video is going to be all about. In my latest video on that new 3-fund portfolio, I got a bunch of questions about, okay, this is great, but what do I do next? How can I add to this? How can I make it even better? I'm going to go over how to add just a little bit more risk for some upside, or how to bring it down and how to keep it more safe, especially for those of you that are closer to retirement. Also going to go over exactly how to pick the best fund for each category, and I'm going to go over why I'm okay with a little bit of fund overlap, because that seemed to be a common theme with some of the comments in that comment section. I'm also going to inform you of where Bitcoin or real estate, where that can jump in on this portfolio as well. I'm Nolan Govea. My students call me Professor G, and I made this channel to make investing simplified. And this is just going to be a pretty quick video on some of my thoughts, especially based off of those comments that I did get in that last video. So I can help clear some things up, but this is going to be kind of like office hours. Just like at the universities that I teach at, when the students want to learn just a little bit more, go a little bit deeper from what the lecture had, they come into my office hours and we discuss. So that's what we're going to do here today. So I was thinking about this investing style that I love to invest with after a hard session yesterday in jiu-jitsu. And I was just thinking the way to be successful in both of those areas, investing and jiu-jitsu, is number one, to be patient. But number two is to understand that there's different ways to do things, and that's 100% okay. I've talked about this in many videos, but everyone should not be investing the exact same way. You shouldn't invest exactly the way that I invest. So I try to teach you things that are going to give you the strategy to be able to build out your own investing style. That's why when I go over my 3-fund portfolio, I'm not actually giving you 3 exact ETFs that you should go invest in. I'm giving you categories, and then you can find the ETFs that you think suit that category best. So just as a reminder, that 3-fund portfolio has a foundational ETF, something like VTI or VU, something that's going to be a very broad total market index. The next fund is going to be something in the dividend space, something like SCHD or VYM. Again, very broad, very safe, has a solid dividend. And then that third category is the growth category. In this category, especially as your base ETF for that category, I do suggest that it be more of a broad growth fund, something like QQQM, SCHG, VUG. And the idea there is that yes, there are going to be some that are better or have been better, at least in the last 5 years, something like VGT. But the problem with VGT as the core in that category is that VGT is purely technology. It's not a broad growth fund. And while yes, it has been crushing it, it's still not the safest, because if technology for some reason were to drop, that whole fund would drop super hard. Whereas if technology were to drop, and you had the growth fund like VUG or SCHG or something, then yes, the technology portion of that ETF would drop, but the other portions, the other sectors within the ETF, will keep you nice and safe. We're not just looking at upside here, we're trying to limit the downside. So now that we understand what the 3-fund portfolio is, or at least the strategy behind it, let's go over the first thing that most people get mad at me for, which is fund overlap. The idea is that I like my new 3-fund portfolio, obviously, but the old 3-fund portfolio, the reason why it was such a good idea is because it had very minimal fund overlap. And for those of you that don't know, fund overlap is just where one ETF has some companies that another ETF has. If one ETF has like 50% of the same companies that this fund over here has, now you're investing in the same companies, just in 2 different areas. That's not necessarily a bad thing. I think a lot of people think,
oh, fund overlap, that's the worst thing possible.
Not necessarily. It's just bad if you think you're investing in 2 totally separate things, but at the end of the day, you are investing in a little bit of the same thing. So anyway, the old 3-fund portfolio was such a cool idea because it was investing in regular US stocks, then it was investing in international stocks, so there was no correlation there whatsoever, totally different, and then investing in bonds, which is totally different than the other 2. So yes, there was no fund overlap in all 3 of those areas, and very diversified. But what I've talked about many times on this channel, and what people like Warren Buffett and other very wise investors have talked about, is over-diversification, or just diversification in general, should not be your ultimate goal. I'm not looking to win the biggest award for the most diversified portfolio. I'm trying to get the biggest return possible while also keeping the most safe. So looking at etfrc.com, you can use this to try to look at some fund overlap. So if we look at the S&P 500, SPY, and QQQ, you can see that there's a 45% overlap, which again is not the worst thing in the world. You can see the ones that are the most overlapped are things like Microsoft, Apple, Nvidia, Amazon, and Meta, which aren't the worst things to be overlapped in. If we look at what the old fund portfolio did with the total stock market index and then an international index, you can see that something like VTI and VXUS, when you put those in, you see that there's a 0% overlap there. So that's just telling you what fund overlap is. You definitely don't want to be investing in the exact same thing in like 5 different areas of your portfolio and thinking that you're diversified enough and safe enough. You do want to have some companies and some ETFs that are much different than others. Right now, the most fun stocks out there are going to be the ones that are high technology, semiconductor, AI. And so you have to be careful because yes, they're crushing it right now, but if that's your whole portfolio and then that were to drop, that's going to be an issue. In my 3-fund portfolio, the dividend fund versus the growth fund have very little fund overlap because the dividend fund is very safe, very boring, dividend style, value style companies. And then on this side, in the growth fund, these are the high growing, high accelerating, more fun types of companies, and so they're totally different there. But the next question I was getting on that other video was, which ETF is going to be best? What about VGT versus QQQM? And again, what I recommend in my 3-fund portfolio would be to have a very safe and broad fund in each of the core positions. I think that we understand this with the foundational one, where you're going to go to total US stock market or the S&P 500. That's pretty self-explanatory. Same thing with the dividend fund. You're probably going to go with like an SCHD or a VYM. Those are just like broad, solid, keep you safe, great. The one that people have the most questions on is the growth category because that's the one crushing it right now. I would still highly recommend that the bulk of that section be something that's a broad fund. That would be something like VUG, QQQM, SCHG. Those are the ones that I think should be like the core there. But if you really want some extra technology or you really like a semiconductor one, you could add that into the growth portion. Just make sure and do the math so that you're in the right section and so that you have a good diversified portfolio for yourself. So if you've decided that your portfolio buildup is going to be similar to mine, where it's just 33% of each one of the 3 categories, great. But in the growth fund, if you're like, I want to have QQQM, but I also want to add in VGT, that's great too. But make sure that those 2 together equal out to 33% still, so that that section is still 33% of the entire portfolio. So maybe of the entire portfolio, you have 20% QQQM, and then maybe 13% or so of VGT. And yes, there's going to be very high fund overlap between QQQM and VGT, but who cares? We're talking about that section being 33% of the entire portfolio anyway. Within that area, you could have as much fund overlap as you want, because when we're talking about fund overlap, it's more so about the different categories and not having too much overlap with the different categories. The next question that I got though was, well, I want to have a little bit more diversification than your 3-fund portfolio. I want to have some international, or I want to have some bonds. Great. That's totally fine, and that's why I was talking about the jujitsu thing at the beginning. You can invest in the way that's going to be best for you as long as you just understand the total strategy. I just think that your total strategy should not be to be as diversified as possible. That shouldn't be the end goal. The end goal should be as high returns as possible with the most amount of safety as possible. However you build that out and whatever makes the most sense to you to do that, go for it. So if you want to add in like 10%, 15% international funds in there, great, throw that in there. That will diversify from the rest of the portfolio. If that helps you sleep at night, go for it. Same thing with bonds. As far as bonds are concerned, if you are closer to retirement or in retirement age, I do think that there's a spot in your portfolio for bonds. When we look at BND, which is one of the biggest ETFs for bonds, we can see that it's a very low expense ratio and a very solid dividend here. And that's what we're looking for in retirement, possibly to be getting a paycheck since you probably don't have a job at this point. The only knock here is that over the last 10 years, on average, it's bringing in about 1.4% appreciation per year. That's obviously not much growth at all, but when you consider the fact that it's bringing in that dividend from before, having just a little bit of growth, but then having a good solid 5% or so per year of dividends and cash flow, that's not the worst thing in the world, especially when it's bringing down your risk specifically. So if you are in retirement or very, very close to retirement, like 2 years away from retirement, it might be a good idea to have a small portion of your portfolio in bonds, or at the very least in a high yield savings account, something outside of the stock market, just because safety is important here. I definitely would not recommend putting all of your money into bonds or all of your money into the high yield savings account. You still want to keep it growing even in retirement age, but there is a case for bonds sometimes. If you're 10 years or more away from retirement, I don't think that there's a case for bonds, but again, you can do the research and you can make your own decision. Now going the totally opposite side of the spectrum, adding in something high risk for that high reward, specifically Bitcoin. Now, Bitcoin, if you don't know anything about Bitcoin, I highly recommend that all you do right now is research it. Figure out what it is, try to understand it. Just like anything else, if you don't understand whatever you're investing in, please don't invest in it. It just doesn't make any sense. But as far as Bitcoin is concerned, as far as your total portfolio, I would be lumping this into the growth section of your portfolio like we were talking about from before. So if you want of your total portfolio 33% to be in that growth style, which is the higher risk, possibly higher reward, then you need to add just that piece into that. So if you want to have QQQM from before and also VGT, but also some Bitcoin, then maybe within that 33%, you have 15% QQQM, 15% VGT, and then like 3% Bitcoin. You just don't want to over risk yourself in your portfolio if your strategy is to have, 33% in each section. I have a couple videos coming out about Bitcoin in the next couple weeks because I think that we just need to educate ourselves on this. And I'm going to try to give you the most unbiased opinion and just give you facts so that you know what's happening. Because over this next year, there's going to be some crazy news and I think some crazy price appreciation with Bitcoin. If we just look at specifically where Bitcoin's at today, it's a little over $68,000. And in the day alone, it's been up about 2%. Just in the last 5 days, it's up 8%. In the last month, up over 50%. This year, again, up over 50%. And obviously over its lifetime, that's just crazy. But over the last year, 215%. Bitcoin is definitely one of those assets that is much more risky than anything else. It's also not like a company, so they don't have sales and things. There's a lot to understand about Bitcoin, and I have a lot of resources for you if you're interested, but what I would highly recommend is that you just keep an open mind and that you just research it. That's what I did. I was against it for so long until I researched what the technology could actually do and how it's going to solve some huge problems that are needed to be solved. The last piece in the portfolio might be something like real estate. And real estate, again, I would put that in the growth category as well, but it could also be in the foundational. It just depends on how you're looking at it, and it depends on what type of real estate. You could do things like REITs, or real estate ETFs. You could also do long-term investing, short-term investing, and there's higher risk but higher reward depending on the different types of real estate that you do. And for that specifically, I made this video all about 6 different ways that you could invest in real estate and get very, very rich and how to do it. I also have this video here on my 3-fund portfolio with all the new updates for 2024. Check either of those out and let me know what you think.